What if I told you the most powerful war in the world right now isn't being fought with weapons, but with debt? No explosions, no headlines of destruction, just numbers. Trillions of dollars moving silently across borders, shaping the fate of entire nations. On one side, the United States, owing more money than any country in history, yet somehow still controlling the global financial system. On the other side, China, lending billions across the world, building roads, ports, and power, quietly expanding its influence one loan at a time. But here's the twist. China is also one of the biggest holders of US debt, which means the world's biggest debtor and one of its biggest creditors are financially tied together in a system neither can escape. So who really holds the power? Is it the country that owes the most, or the one that lends the most? Or is the truth far more dangerous? Because in this invisible war, the real weapon isn't money, it's control. And by the end of this video, you'll understand exactly how this system works and who is truly winning the global debt war. In today's world, power is no longer defined solely by military strength, territory, or natural resources. Instead, it is increasingly shaped by something far less visible but far more influential: debt. Beneath headlines and political speeches, a silent conflict is unfolding across financial markets and global institutions. This is not a war fought with weapons, but with bonds, loans, and economic leverage. It is a debt war, and at its center stand two superpowers, the United States and China. At first glance, the roles seem obvious. The United States appears to be the world's largest debtor, carrying trillions of dollars in obligations and running persistent budget deficits. China, on the other hand, is often portrayed as the world's largest creditor, lending money across continents and accumulating vast reserves. But this simple narrative hides a deeper, more complex reality. The United States possesses a unique advantage. Its currency, the dollar, is the backbone of the global financial system. International trade, especially in commodities like oil, is conducted largely in dollars. Central banks hold dollar reserves, and global investors seek dollar-denominated assets for stability. This creates a constant demand for U.S. debt, particularly Treasury bonds, which are seen as one of the safest investments in the world. China operates differently. Rather than relying on global demand for its currency, it extends its influence by lending directly to other nations. Through infrastructure financing, development projects, and trade agreements, China builds long-term relationships with countries in Africa, Asia, and Latin America. These loans often fund critical projects, but they also create financial obligations that tie those nations to China's economic interests. Yet the relationship between the United States and China is not purely competitive. It is also deeply interconnected. China holds a significant portion of U.S. debt, creating a financial link that binds the two economies together. If China were to aggressively reduce its holdings, it could disrupt global markets. However, such a move would also harm China's own financial position. This mutual dependence defines the nature of the debt war. Neither side can act recklessly without consequences. Each holds leverage, but that leverage is constrained by the risk of self-inflicted damage. It is a delicate balance where power is exercised carefully and strategically. As global tensions rise, this financial rivalry becomes more important. Trade disputes, currency fluctuations, and geopolitical conflicts all intersect with the dynamics of debt. While public attention often focuses on visible conflicts, the true struggle lies beneath the surface. Because in a world built on borrowing, power does not belong to those who owe the most or lend the most. It belongs to those who understand the system and know how to use it. To understand how the United States maintains its global influence, you must look beyond its military and political reach and examine its financial system. What appears to be a massive burden of debt is, in reality, a carefully structured mechanism that reinforces American power. The U.S. has transformed borrowing into a strategic advantage, creating a system where its debt functions as a cornerstone of global finance rather than a weakness. At the center of the system is the dominance of the U.S. dollar. As the world's primary reserve currency, the dollar is essential for international trade and finance. Countries need dollars to buy commodities, settle transactions, and stabilize their economies. This demand extends to U.S. Treasury bonds, which are widely regarded as safe, liquid, and reliable assets.
When the U.S. government issues debt, it is not simply borrowing money to cover expenses. It is providing the world with a financial instrument that institutions and governments depend on. In times of crisis, demand for these assets often increases as investors seek safety. This creates a paradox where economic uncertainty strengthens demand for American debt instead of weakening it. Another critical factor is that U.S. debt is denominated in its own currency. This gives the country a level of flexibility that most nations do not have. The government can issue more currency to meet its obligations, reducing the risk of default. While this can lead to inflation if mismanaged, it provides a powerful tool for navigating economic challenges.
This system allows the United States to sustain large deficits and finance significant expenditures, including military operations, social programs, and economic stimulus measures. Rather than being constrained by debt, the U.S. uses it to support its global role. Beyond economics, the U.S. financial system serves as a geopolitical instrument. Control over dollar-based transactions gives the United States influence over international trade and finance. Sanctions, financial restrictions, and access to global payment systems can shape the behavior of other nations.
However, this power is not without limits. It depends heavily on trust. Investors must believe in the stability of the U.S. economy and the reliability of its institutions. If confidence were to decline significantly, demand for U.S. debt could weaken, undermining the entire system. Despite these risks, the structure remains resilient. The integration of the dollar into global markets creates a self-reinforcing cycle. As long as the world continues to rely on the dollar, the United States retains its ability to borrow at scale and maintain its financial dominance. In the debt war, America's strength lies not in avoiding debt, but in controlling the system that makes debt valuable.
China's approach to debt differs fundamentally from that of the United States. Instead of building dominance through borrowing, China has focused on becoming a global lender. This strategy is rooted in long-term planning, infrastructure development, and the expansion of economic influence beyond its borders. By financing projects and extending credit, China positions itself as a central player in the growth of developing economies. A key element of this strategy is large-scale infrastructure investment. Across Africa, Asia, and parts of Latin America, Chinese funding supports the construction of roads, railways, ports, and energy facilities. These projects are often transformative, enabling trade, improving connectivity, and stimulating economic activity. For many countries, access to such funding provides opportunities that might otherwise be unavailable. However, these loans come with obligations. Borrowing nations must repay the funds, often over long periods and under specific conditions. When projects generate strong economic returns, repayment is manageable, but when growth falls short, debt can become a burden. In such cases, China may renegotiate terms, extend repayment timelines, or seek alternative arrangements. This creates a complex dynamic. On one hand, China is seen as a partner in development, providing resources and expertise. On the other hand, its role as a creditor can lead to concerns about dependency and influence. Control over key infrastructure assets can translate into strategic advantages, affecting trade routes and regional stability. China's strategy also faces internal challenges.
Its own economy carries significant levels of domestic debt, including obligations held by local governments and state-owned enterprises. Balancing domestic financial stability with international expansion requires careful management. Another limitation is currency influence. Unlike the US dollar, China's currency is not widely used as a global reserve. This restricts its ability to scale its financial system globally. Efforts to increase the international use of its currency are ongoing, but progress is gradual. Transparency is another issue. Many of China's lending agreements are not fully disclosed, making it difficult to assess risks and terms. This can create uncertainty among borrowing nations and global investors. Despite these challenges, China continues to expand its financial reach. Its strategy is not about immediate dominance, but about building long-term influence through sustained engagement and investment. In the debt war, China is not trying to replace the existing system overnight. It is building a new one, carefully, steadily, and strategically. Despite the competitive narrative surrounding the United States and China, their financial relationship is deeply interconnected. This interdependence creates a situation where both nations rely on each other in ways that limit direct confrontation. The debt war is not a simple rivalry, but a complex balance of cooperation and competition. One of the clearest examples of this connection is China's holdings of U.S. Treasury bonds. For years, China has been among the largest foreign holders of American debt. This position provides a theoretical form of leverage. If China were to sell a significant portion of its holdings, it could influence bond markets and interest rates. However, this leverage is constrained by mutual risk. A large-scale sell-off would reduce the value of China's remaining investments and could trigger global financial instability. Such instability would likely affect China's own economy, given its reliance on global trade and economic growth. As a result, the option exists but is rarely considered practical. The United States also depends on foreign investors to sustain demand for its debt. While domestic institutions play a major role, international buyers contribute to the stability of the market. This creates a shared interest in maintaining confidence and avoiding disruptive actions.
Trade further reinforces this interdependence. The United States is a major consumer of Chinese exports, while China relies on access to American markets. This economic relationship supports both economies, even as political tensions arise. Currency dynamics add another layer of complexity. The dollar remains dominant, but China is working to expand the use of its currency in international transactions. This gradual shift introduces competition, but does not immediately replace existing structures. The result is a delicate equilibrium. Both nations possess tools that could disrupt the system, but using them would come at a high cost. This encourages restraint and strategic decision-making. In this environment, the debt war becomes less about direct confrontation and more about positioning. The United States seeks to preserve its leadership within the current system, while China focuses on building alternatives and expanding influence. Global events can shift this balance. Economic crises, policy changes, or geopolitical conflicts can alter relationships and create new pressures. Yet the underlying interdependence remains a stabilizing factor. This dynamic highlights a central paradox. The two largest competitors in global finance are also deeply reliant on each other for stability. As long as this relationship continues, the debt war will remain controlled rather than explosive. Beyond the rivalry of the United States and China lies a broader global landscape where other nations play a critical role. These countries are not merely observers, they are active participants whose decisions influence the direction and outcome of the debt war. Their need for capital, development, and economic stability places them at the center of this evolving competition. For many developing nations, access to financing is essential. Infrastructure projects, industrial growth, and social development require significant investment. Both the United States and China offer pathways to achieve these goals, but through different mechanisms.
The U.S.-led system provides access to global financial markets, investment flows, and institutional support. Countries can raise capital through bonds, attract foreign investment, and engage with established financial organizations. However, this often comes with conditions related to governance, economic policy, and transparency. China offers an alternative approach. Its financing is frequently tied to specific projects, particularly infrastructure. This can accelerate development by delivering tangible results quickly. Roads, ports, and energy systems can transform economies, improving connectivity and productivity.
Yet, these opportunities also carry risks. Loans must be repaid, and projects do not always generate expected returns. When economic performance falls short, debt burdens can increase, leading to financial strain. This creates situations where borrowing nations must renegotiate terms or seek additional support. Countries navigate this environment by balancing relationships. Engaging with both systems allows for diversification, reducing dependence on any single source of financing. This strategy can enhance resilience, but requires careful management. Debt crises remain a significant concern. External shocks, currency fluctuations, and political instability can make repayment more difficult. In such cases, the influence of creditors becomes more pronounced, shaping policy decisions and economic outcomes. The competition between the United States and China also encourages innovation. New financial institutions, regional partnerships, and alternative payment systems are emerging. These developments could lead to a more diverse and flexible global financial system. However, fragmentation carries risks. A divided system may reduce efficiency and increase uncertainty. Coordination becomes more challenging, and trust can be harder to maintain. For nations caught in between, the debt war is not theoretical. It affects their economic strategies, development plans, and geopolitical choices. Their decisions collectively shape the global financial environment. Ultimately, these countries are not just influenced by the debt war, they influence it. Their choices determine which systems gain traction, which partnerships succeed, and how the balance of power evolves. As the financial rivalry between the United States and China continues, the question of control becomes increasingly complex. It is tempting to look for a clear winner, a single nation that dominates the global debt system. But the reality is more nuanced. Control over debt is not absolute. It is shaped by influence, trust, and the structure of the financial system itself. The United States currently holds a dominant position. The dollar remains the primary reserve currency, and U.S. financial markets set global standards. Treasury bonds are widely regarded as safe assets, forming a foundation for international finance. This gives the U.S. significant influence over how debt is issued, traded, and valued. China, however, is steadily building an alternative. Through lending, infrastructure investment, and the development of its financial institutions, it is creating new pathways for economic interaction. While this system does not yet match the scale of the U.S.-led framework, it introduces competition and choice. The key to control lies in rule setting. Nations that define the standards of financial transactions, legal frameworks, and institutional practices hold the greatest power. In this regard, the United States leads, but its position depends on continued confidence in its economy and governance. China's strategy focuses on long-term change. By expanding its influence and promoting its currency, it aims to reduce dependence on existing systems. This gradual approach avoids direct confrontation while building capacity for the future. Technology adds another dimension. Digital currencies, financial innovation, and alternative payment networks have the potential to reshape global finance.
These tools could alter how debt is managed, reducing reliance on traditional intermediaries.
In this evolving landscape, no single country fully controls the world's debt. The system is interconnected, with multiple actors influencing outcomes. Governments, institutions, investors, and markets all play roles in determining how debt functions. The debt war is therefore not a contest with a definitive endpoint. It is an ongoing process of adaptation and competition. Power shifts gradually, influenced by economic performance, policy decisions, and global events. The United States controls the present structure. China is shaping potential alternatives. Other nations influence how these systems interact and evolve. In the end, control over debt is less about ownership and more about influence. It depends on the ability to maintain trust, set standards, and adapt to change. The true winner will not simply be the largest borrower or lender. It will be the one that understands the system best and uses that understanding to shape the future.
The debt war between the United States and China isn't a battle with a clear winner. It's a system, complex, interconnected, and constantly evolving. The United States still controls the structure of global finance, powered by the dominance of the dollar and the trust of the world. China, meanwhile, is steadily building an alternative, expanding its influence through lending, infrastructure, and long-term strategy. But here's what most people miss. Neither side can afford to destroy the other, because the moment one collapses, the entire system feels the shock. And that's what makes this war so different. It's not about domination, it's about balance. A balance held together by trust, risk, and trillions of dollars in debt. So the real question isn't just who controls the world's biggest debt, it's what happens if that control is ever lost. Because if the system breaks, it won't just affect governments or economies, it will affect everyone. And that means you. Now, the next time you hear about national debt, trade wars, or global power shifts, you'll know the truth behind it. This isn't just economics. This is the real game of power.